Hello, my name is Ignacio Diaz, and today we are going to explore a topic that is key for any company valuation, and we will begin by understanding fair value and the importance of using certificate price, avoiding errors that could generate financial and tax impact. And the concept of fair market value, and the fair market value represents the estimated price at which an asset could be bought or sold in the open market between two independent will-informed parties without on the price to complete the transaction. In other words, it's the value that reflects that reasonable buyer will be willing to pay and what a reasonable seller will accept under normal market conditions. In the formal definition, according to the international standard, fair value is defined as the price that would receive to sell an asset or pay to transfer levied in an orderly transaction between market parties at the master date. And key elements of the definition is market price, orderly transaction, market participants, and measurement date. Difference between fair value, book value, and value market. And these three concepts are frequently used in business and asset valuation, but they represent different approaches to determining the value of an asset or organization. And one fair value, two book value, and three market value. In a practical example, in the case of a technology company, fair value is calculated by projecting future cash flows, discounting them at a 10% rate, and adding the residual value, resulting in a total value of $25 million, representing Daniel versus Wall. And in the example of a finance assets bond with a nominal value of $1 million and 95% in the market, so their fair value is 905 and reflecting the real market price rather than accounting value. The importance of professionalization in valuation is a correct valuation of company or asset and requires technical knowledge and objectivity, and so it should be performed by a certified price or a financial person. Is required, it ensures technical rigor and proper use of recurring methods, and provides impartiality and ensure regularity, compliance, and legal support during audits or reviews.
Valuation is not merely an accounting task. In critical moments such as mergers, acquisition, IPOs, or succession, it allows informed decision making. It helps maximize benefits, protect shareholder interests, and identify value synergies, which are additional benefits generated by combining companies or executing strategic transitions. Mergers combine two or more companies into a larger, more competitive entity. Acquisition involves purchasing one company by another. This transaction aims to expand business size, enhance competitiveness, and respond to market opportunities or threats. Valuation uses mainly two methods: discounting cash flow, estimated the company value based on its future cash generation capacity. Comparable companies multiples uses recent transaction of similar companies as a market reference. Valuation also identifies value synergies, such as cost reduction, market expansion, or technological integration. For example, a company acquiring a competitor can use DCF to justify a price based on expected future cash flow. At the same time, comparable multiples provide a market reference to ensure a competitive negotiation and a fair price for both parties. This way, valuation becomes a strategic tool to maximize transaction value. An IPO is when a private company sells shares to the public for the first time, becoming a public company with access to capital markets. Before issuing shares, valuation is essential to determine the initial share price, attracting investors while ensuring fairness for funders. Companies like Mercado Libre or Airbnb perform it through valuation, combining projected cash flow and comparable multiples, allowing them to set a competitive and accurate IPO price. In family-owned or privately held business, transferring ownership without proper valuation may put the company value in risk. Valuation considers asset, cash flow, and growth prospects to maintain value during transition. Strategies include tax and legal planning, clear management roles, and transparent communication with heirs or partners. The goal is to ensure operation continuity and preserve the value built over years. In conclusion, valuation is more than a pricing exercise. It is a strategic tool that enables informed decision making, identifies synergies, and protects shareholder interests. As Warren Buffett said, price is what you pay, value is what you get. Proper valuation transforms every transaction into an opportunity to grow and strategic consolidation.
Valuation connects the financial, legal, and the fiscal aspect of the business. It establishes a fair directly value of the business or the assets and necessary compliance with the laws accounting standard and avoiding conflict between parties in parties financial parties in transaction, taxes, or legal disputes. Statutory and fiscal reason cause were allowed calculation in arrangement and gift, merger and disquisition, private transaction, capital and compensation relations, judicial payments or compensation, fiscal function allows to provide a fair value for tax payments, audits, a tax rebate, accounting complaints. Legal disputes valuation play a key role in resolving financial disputes under negotiation for evaluated judicial experts, acts, and expert witness. On application, business both divorces the parties separation, disputed shall purchases, forced liquidation of mergers, or compensation in expropriation or remakes. Examples: India, Tata in serious mystery discussed over minority share value. The expert valuation was key determining whether of their prices reflect fair value. International deal Inca pricing delayed iron shareholders claimed the sale undervalued the shares. The court ordered a full valuation review under the correctness financial standards. Stock prices do not always reflect company true value, as they may be influenced by speculation, rumor of external factors, temporary supply and demand change. Difference between types of value um, is market value, intrinsic value, and speculative value. When intrinsic and market values differ, valuation is used to decide whether to buy, sell, or hold asset. Valuation of companies. Insured values are accounting determinable valuation protect the company and the taxpayers from debt penalties and potential dispute with tax authorities. Protection clauses show that a professional objective valuation can be decided in the favor of a company of inverse of fiscal position. In conclusion, fiscal evaluation warrants transparency, accounting, and regularly complicates a key tool for proper tax administration and defense during audits of reviews.
Today, I will be talking about how internal valuation. When we hear the word valuation, we often think of financial figures, how much a company is worth on monetary terms. One, strategic planning and growth, measuring profitability and expansion. Internal valuation helps evaluate how profitable each business unit product in line or project with which project. Identify and make information decisions. Application in invest bonds and project analysis. Valuation techniques such as need present value and internal rate of return are essential for strategic planning. Special assets. Values of intangible assets. Intangible assets are critical for modern competitiveness and often represent more value than physical assets. Internal valuation identifies and quantifies these components such as brands and patents represent reputation, innovation, and differentiation, intellectual property and know-how, and human capital, experience, relationship, and organization culture. For example, a strong brand can increase in a competitive market value even intangible assets are modest, as seen with Apple or Coca-Cola. Valuation of bonds, shares, and executive compensation plans. In management control, it is also necessary to assess internal financial instruments such as shares of equity participation, measure capital profitability, and profit distribution. Corporate bonds helps estimate solvency and financial costs. Executive compensation plans link leadership performance to value creation. Example in a stock-based incentive plans motivates execution to increase the company value rather than focus only on short-term profits. Value culture and fair compensation. Incentives leaderships and corporate value. Internal valuation promotes a culture where incentives are aligned with value creation. And I will design a compensation system motivation employees and managers to focus on sustainable results. Rewards should be based on real value indicators show a stable or market value growth. Not just temporary sales or profits. Example, if manager bonus invested only in sales growth, they might sacrifice profitability, but if see tied to value creation, they will provide an efficiency and long-term performance. Segment objective how internal valuation drives efficiency, transparency, and sustainability. The main objective of this segment is to demonstrate how internal valuation becomes an strategic pillar for decision making, performance, measurement, and long-term. Corporate sustainability is not limited to assigning a number to the company worth in integrants financial, operation, and human dimension to create a complete picture of organization value. Number one, promoting strategic efficiency or linking financial results with strategic goals and ensures that every action, improving cost and performance control, continuous valuation reveals inefficiencies and process assets, and manages decision helping to correct deviation early and result the organization becomes leaner, more adaptable, and focusing on sustainability profitability.